Well, we see the U.S. economy slowing from 3% last year to about 2.5% this year. The global economy clearly is slowing. China has put in a lot of stimulus over the last 6 months, but the big uncertainty is really trade and what's going to happen with the U.S.-China relationship. The Fed has clearly pivoted in a major way, as have other central banks, towards a more dovish policy, and I think that's supporting markets. But longer term, we're concerned. We think the valuations are rich on most assets, and we think this ongoing conflict between the U.S. and China is going to continue. So overall, we would be reducing risk here, and we're quite cautious on markets.
Stuart, I was just looking at the VIX at 15.5, so come quite significantly back down from its spike on Monday and last week. What's your take on that, and is that now good value to get some protection in portfolios?
Yeah, to your point, it's been a really difficult time for the markets. This catalyst related to trade is hugely impactful, has an uncertain timing and uncertain magnitude, and no one actually knows which direction it's going to work out. So volatility markets have been very, 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 very responsive to trade headlines. In our view, the VIX was a couple points too high at the end of last week. The drop that we've seen this week, in our view, puts it about in line with fair value, both relative to other asset classes and also just relative to the movements we've seen in the S&P underlier over the last couple of weeks.
Mark, within your sort of warning of caution on risk assets, where do you guys think is a safe bet right now? Where do you hide out?
Yeah, so really there's 3 areas we still like if you look at the various sectors of the market. We still like the consumer. One thing with the Fed's pivot, we think rates are going to be lower for longer, particularly in a world where you've got rising uncertainty, slow growth, and low inflation. So the consumer should be supported. We like healthcare, we like telecom and REITs. Secondly, we like housing. We continue to like non-agency mortgages, building materials. And we think that housing will be more mid-cycle versus autos, which are later cycle. And the third area is really midstream energy. There is this huge energy revolution going on. It's been going on for 10 years. The U.S. is disproportionately winning. We're among the lowest cost producers in the world of LNG and the most secure providers. So the U.S. should win in terms of energy, and those are the 3 areas we're most constructive on now.
Stephanie, do you feel like the momentum is there now to put money back to work more meaningfully, back above 2,800, all sectors higher, flat for the week?
It's been a year of rotation, and so it depends on what you're buying at this point. I mean, this market today feels very defensive to me, and also because you see staples and you see utilities doing well. Financials are participating too, but what you're really seeing is growth again. And what that tells me is that people are kind of recalibrating what they expect growth overall for the economy to be. Slower growth, which means you want growthier stocks, secular growing stocks. So all of the FANG are doing quite well as well. I'm involved in all of those, but I definitely have a cyclical bias because I think that's where the value is. But we need to get through trade to really see those stocks do better.
Finally, Stuart, you guys see the second half, outlook improving. So is that a safe bet to be in some of the growthier names?
Yeah, I agree with everything Stephanie said. Our view coming into 2Q is you were going to get a reacceleration in growth. The trick for the last 4 or 5 months is if you look at something like the ISM, it's just been a sawtooth. It's up, down, up, down, up, down each month. And to Stephanie's point, that makes it really hard to allocate. It goes up, you want to be in cyclicals. It goes down, you want to be in defensives. Our view for the second half is 2Q is an improvement, and then you stay at trend or above trend growth for the rest of the year, unless trade, of course, knocks us off of that horse. But otherwise, yeah, we do think you want to be reasonably cyclical going into the second half, with the caveat that we are late cycle and we do have a lot of underlying trade risk. So, that value-y, growthy kind of combo, I think, makes a little bit of sense here. And I think that's where most of our clients are looking at the market.